Hi there, we are from MPU3422 Integrity and Anti-Corruption. We are Group 15 and our instructor name is Mr. Ahmad Kamal Sadin. Today we will be presenting group project the Wells Fargo Fake Account Scandal Case Study happening in USA during 2016. So let me begin with the introduction. Integrity and anti-corruption are essential in organizational governance, especially in the financial sector, because they help maintain public trust and accountability. From the perception of agency theory, managers may act in their own self-interest rather than the interest of stakeholders. Therefore, strong governance mechanisms are needed to control opportunistic behavior. Corruption can weaken institutional legitimacy and reduce economic efficiency. Hayden and Wazan, 2022, argue that corruption contributes to many global challenges, while ICAC 2019 emphasized that exposing and preventing corruption is crucial to protect public resources and public confidence. In this presentation, I will use the Wells Fargo scandal as a case study to show how integrity failures and weak governance can lead to unethical behavior in organizations. The Wells Fargo fake account scandal in 2016 is a key example of systematic integrity failure in a major financial institution. Employees created unauthorized customer accounts to meet aggressive sales targets set by management. This scandal shows how governance failures and distorted incentives can normalize unethical behavior. It highlights the importance of ethical organizational culture, strong board oversight, effective whistleblowing system, and regulatory intervention to address agency problems. Overall, this case provides important lessons for strengthening corporate governance and anti-corruption frameworks in financial institutions and other organizations, and it shows why ethical leadership and accountability systems are critical to prevent similar misconduct.
Thank you. I will continue the background of the case. First, Wells Fargo is an American multinational banking and a financial services company. It was founded in 1852 and is headquartered in San Francisco, California. It is also one of the largest banks in the United States. However, the company was involved in one of the biggest corporate misconduct scandals in the U.S. banking history. This scandal occurred between 2011 and 2016 and was publicly exposed in 2016. Well, I'll pass to the next presenter.
Now I will talk about who was involved in this case. First, the employee of Wells Fargo Company were involved. Many workers opened bank accounts without customer permission. They did this because they were under strong pressure to meet sales goal. If they didn't reach their target, they could lose their job. Second, the senior manager were also involved. The CEO at that time was John G. Stump. The head of community banking was carried to they were criticized because they didn't stop the problem. Even though there were warning signs, they continued to push high sales goals. This made the problem worse. Finally, the customers were the victims. Many customers didn't know that accounts were opened in their names. Some of them lost money and had damage to their credit record. This made people lose trust in the bank. In short, this case involves employees, top managers, and customers, and it affects many people. I will pass to the next person.
Alright. So what they did, they opened millions of unauthorized accounts, checkings, and saving accounts without customer consent, applied for credit cards without customer knowledge or permission, forged customer signatures on account application documents, transfer money from customer real accounts into fake accounts, charge unauthorized fees such as overdraft fees and service charges.
This slide focuses on the offenses committed in the Wells Fargo fake account scandal. First, the bank engaged in fraud and deceptive practices by allowing employees to open accounts without customer consent and charging fees on services that were never requested. Second, this action breached multiple con- consumers protection law, including the Truth in Lending Act and the Electronic Fund Transfer Act and UDAAP regulations, all of which exist to protect consumers from unfair and deceptive financial practices. Finally, Wells Fargo misused customers' personal data, failing in its duty to protect sensitive information. This represented a serious breach of trust and contractual obligations between the bank and its customers.
So this slide discusses some implications faced by the organization, country members. Firstly, we will talk about the company itself, Wells Fargo. They faced a fine of $185 million, which is a long-term financial burden for them. Then they faced criminal charges, the top executives of the bank, including fraud, conspiracy, and making false statements. Then the CEO, John Stumpf, faced demotion. Secondly, for the individuals, public became skeptical of the banks and their business dealings. They faced trust issues regarding safety of their dealings and involvement with the banks. Then we have the competitors of Wells Fargo. They implement and enhance transparency when dealing with customers and stakeholders. They have the pressure of proving and maintaining ethical business practices. Then they have to reassure the customers of safety of their transactions and dealings with the bank. And lastly, we have the financial industry. Regulatory changes to improve integrity and stability for the whole industry. Then reevaluating unrealistically high sales targets set for employees so they are more feasible and achievable.
What actually happened at Wells Fargo? The biggest problem wasn't just the fake accounts, it was the fear of seeing your colleague do something wrong but being too scared to say anything because you're worried your manager will fire you. So the first thing any company needs to do is find a way to report staff and illegal behavior without being scared. You need independent hotlines where people can stay anonymous. If the staff can't speak up, the company will never fix its problems. Next, we have to talk about target culture in Wells Fargo. For them, it was all about the numbers. If you didn't hit your sales, you're basically finished. This kind of pressure makes good people do bad things to survive. Firstly, we have to change the way we reward staff. It shouldn't just be about who made the most money, it should be about who followed the rules and treated the customers fairly. If the targets are impossible, people will find a way to cheat. It's as simple as that. Then we have the check and balance part. Wells Fargo had many warning signs, but their internal systems were too weak to catch them. To stop this, companies need to use data. We have analytics that can instantly flag if something looks wrong, like if a customer has 5 bank accounts that they didn't ask for. The people who are checking shouldn't be from the same department because you can't ask someone to check their own homework and expect them to be honest about their mistakes. And lastly, we can talk about accountability. Usually when something goes wrong, the junior staff gets blamed while the bosses stay safe. In this case, the leadership is just as guilty because they allowed it to happen. If you want people to trust the company again, the big bosses must take responsibility. If someone breaks the rules, they must face the consequences no matter how high up they are. At the end of the day, integrity starts from the top. If the leaders don't care, why should the staff?
Now I will talk about the lesson we can learn from the Wells Fargo fake account scandal. The first lesson is about company culture. At Wells Fargo, workers were pressured to reach very high sales target. This made some employees do wrong things, like opening fake accounts. It shows that when a company only cares about money and not ethics, bad behavior can happen. Companies should create a culture that encourages honesty and doing the right things. The second lesson is ethical leadership. Leaders at Wells Fargo ignore warning from employees. Workers were afraid to speak up because the reporting system was weak. Good leaders must show ethical behavior and make sure employees can report problems safely. The last lesson is about control and responsibility. Wells Fargo did not have strong monitoring, so the fake account went unnoticed. Companies should do audits, checks, and use data tools to check problems early. Everyone, including bosses, must take responsibility for wrong action. This helps rebuild trust with employees and customers. And now we'll pass it to the next person.
Thank you. So here is the conclusion part that to conclude the Wells Fargo fake account scandal was not simply a case of employee misconduct. It was a systemic failure of leadership, governance, and corporate culture. The unrealistic sales targets created intense pressures on employees which encouraged unethical behavior. At the same time, weak internal controls and ignored warning signs allowed the misconduct to continue for years. So, as a result, Wells Fargo suffered severe financial penalties, reputational damage, and a significant loss of public trust. This case highlights several important lessons about integrity and anti corruption. First, integrity must always be prioritized over short term profit. When organizations focus only on performance targets, ethical standards can be compromised. So, second, ethical leadership is essential. Leaders set the tone for organizational culture. Third, strong internal controls and effective monitoring systems are necessary to prevent corruption from becoming systemic. Finally, whistleblower protection and accountability mechanisms are crucial to ensure misconduct is reported and addressed promptly. Ultimately, sustainable success in any organization depends on trust, transparency, and a strong commitment to integrity. The Wells Fargo scandal reminds us that without integrity, even the largest and most successful institution can fall. But with strong governance and ethical leadership, corruption can be prevented. Thank you.